All right, let's talk about the Federal Reserve. You know, the people in charge of steering the massive ship that is the U.S. economy. Well, heading into 2026, the Fed is in a really tight spot, caught between what the economic data is telling them and some pretty intense political drama. And, you guessed it, how this all shakes out is going to hit your wallet. Because at the end of the day, that's what this is all about, right? The big question for all of us is, what are the Fed's moves going to mean for the interest rates on our mortgages, our savings accounts, our credit cards? So, to get a handle on that, we really need to dig in. Okay, so first up, we have to see the world exactly how the Fed sees it. Think of this as getting a peek at their official dashboard, looking at the same economic vital signs that they're using to make these huge decisions. So, what's the official line? Well, according to Fed Vice Chair Philip Jefferson, the mood starting the year is cautiously optimistic. The thinking is the economy looks like it's in a good spot to keep growing, even while they're working to get inflation back down. But trust me, cautiously is the key word here. A big piece of that optimism comes from some pretty surprising data. I mean, just look at that jump. The economy, GDP, grew at a really strong 4.3% clip in late 2025. That is a seriously powerful engine, and it gives the Fed some confidence that the economy won't just stall out on them. Now, let's switch over to the job market, because this is where things get a little more complicated. On the one hand, you can see job gains have definitely slowed down. But on the other, the unemployment rate has only ticked up a little to 4.4%. So yeah, the labor market is cooling off, but it's not collapsing. This is a super delicate balancing act for the Fed. They want it to cool down to help fight inflation, but they absolutely don't want to cool it down so much that it triggers a recession. And that, of course, brings us to the big one, inflation. We have made some major progress since those painful peaks back in 2022. But if you look really closely at the right side of that chart, you can see the line has kind of flattened out. Inflation is just stuck. It's at 2.7%, and it's stubbornly refusing to go down to the Fed's 2% target. It feels like the final stretch of this marathon is proving to be the hardest part. So the big question is, why has progress stalled? Well, when you pop the hood and look inside the numbers, you find this weird puzzle. Inflation for things like rent and services is actually coming down, which is fantastic news. But all that progress is getting canceled out because the prices for goods, think cars, appliances, stuff like that, are going up again. This internal tug of war makes the Fed's job incredibly tough. So, with this mixed bag of data, some good, some not so good, what's the Fed's master plan? Let's take a look at the actual levers they're pulling to try and navigate this whole thing. Now, the Fed has definitely not been just sitting on its hands. They've already cut their main interest rate by a pretty significant amount, 1.75 percentage points. They've been doing this to try and balance the risk of inflation staying too high with the risk of the cooling labor market getting way too cold. And all those cuts have brought their policy rate into this special zone that economists call the neutral rate. The best way to think about it is like the Goldilocks of interest rates. It's not too hot to cause inflation, and it's not too cold to cause a recession. It's supposed to just let the economy cruise along. So right now, their stance is basically to wait and see. Okay, but interest rates aren't the only tool they have. There's this other massive thing, the Fed's balance sheet. Since the middle of 2022, they've been shrinking it, basically pulling over $2 trillion out of the financial system. That process just wrapped up, and now they've switched gears to something they're calling reserve management. And listen, this is a really important distinction to make. A lot of people hear that the Fed is buying assets again, and they immediately think, oh no, it's more QE, that emergency stimulus stuff. But it's not. Vice Chair Jefferson was super clear about this. Reserve management is more like routine financial plumbing. It's not about flooring the gas pedal, it's more like making sure there's enough oil in the engines so that everything runs smoothly day to day. It's all about stability, not stimulus. Okay, so that's the inside story, right? A data-driven Fed trying to carefully balance this really complex economy. But is the economy the only thing driving these decisions? Because now we have to turn to the outside story. There's a changing of the guard happening at the Fed, and it's creating this political pressure cooker that could honestly change everything. You see, 2026 is shaping up to be a year of huge change for the Fed. First off, Chair Jerome Powell's term is up in May. Second, depending on how a few things shake out, President Trump could end up appointing a majority of the Fed's main board. And third, you've got the annual rotation of voting members from the regional Fed banks, which brings a whole new lineup of voices and opinions to the table. And this quote from economist Huan Wen just nails the tension perfectly. The big question isn't just, what does the data say we should do anymore? It's becoming a battle between what the Fed should do, based purely on economics, and what it will do, thanks to all these new external pressures. And you can see that shift pretty clearly when you look at the new voting members. One analysis shows that half of them are considered dovish, which just means they tend to favor cutting interest rates. Only a small fraction are hawkish, or the type who'd rather keep rates high. This isn't just about a few new faces. It could signal a fundamental change in how the Fed thinks about risk, maybe a new willingness to tolerate a little more inflation to protect jobs and keep the economy growing. So let's bring all of this home. With this big conflict brewing between the data and the politics, what does it all actually mean for you and your money? It's really as simple as this. The Fed's decisions have a direct line to your wallet. The outcome of their debates, their struggles with the data, and the political pressures, it's all going to show up right there on your bank statements. Here's how it'll likely play out. If those dovish voices win and the Fed decides to cut rates more, you're probably going to see lower borrowing costs for big stuff like a house or a car. The variable interest rate on your credit card debt could get cheaper too. But, and this is a big but, there's a flip side. You know those awesome high-yield savings rates we've all been enjoying? Yeah, they will almost certainly start to come down as well. So as we look ahead, that really is the central question, isn't it? Will the Fed's next move be guided by the cold, hard economic data flashing on its dashboard, or by the intense political pressures that come with a changing of the guard? The answer is going to determine the cost of money for millions of us. A lot to think about.